Welcome back. In today's video, I'm going to show you what an asset allocation ETF is and why I recommend most people use these over other types of investing. Basically, an asset allocation ETF, sometimes called an all-in-one ETF, is a fund of funds. So it's an ETF made up of other ETFs. So for example, if you watched my videos on index ETF investing, I'll use XUS as an example. That is iShares S&P 500 Index ETF. And basically XUS, since it follows the S&P 500, holds about the 500 biggest companies in the US. So it holds about 500 individual stocks in that one ETF. Whereas an asset allocation ETF might hold XUS as one of its securities, and the asset allocation might only have 4 or 5, maybe 6 different holdings rather than up to 500 or thousands of holdings. So I'm just going to use iShares as an example again. It's not a recommendation that you use iShares or anything. It's Canada's largest ETF provider, and their website is really user-friendly, and I really like what they've done with it. So there's just a few things that I wanted to show you. So here on their page for the all-in-one ETFs or the asset allocation ETFs, if you just scroll down to the target asset allocations, you can see all you need to worry about with these asset allocation ETFs is your risk tolerance. So when you build your own portfolio, you have to worry about your sector allocations, your geographical allocations, all that different stuff. Whereas with these target allocations, all that is taken care of. All you need to think about is how much risk am I willing to take? So they come in the form from 100-0 to 100 equity, 0% bonds, all the way down to 20% stock, 80% bonds. And again, if you're going anything less than a balanced portfolio, you're probably fearing the market a little bit. So there's probably other types of investments that you could use other than those. So I rarely recommend anything under a 60-40 balanced portfolio. And if we dig a little bit deeper into these 5 different asset allocation ETFs that iShares carries, you can see that they're all broken down by geographical allocation. So if you look at XEQT, it is the 100-0 portfolio, so 100% equity, 0% bonds. And you can see that their target allocation is 45% US, 25% Canada, 25% international. And then they've got this 5% dedicated to emerging markets. Emerging markets tend to be the countries like China, India, Taiwan, South Korea, Brazil, all those countries that are a little more volatile. They're up and coming. So there's big gains to be had, but there's also big losses to be had. So because of the volatility, generally you're going to have a smaller allocation in your portfolio for those. And if you look at their balanced portfolio, they called it XBAL, XBAL, again 60-40. And you can see that 27% of their portfolio is dedicated to the US stocks, 15% both to Canada and international. You have that 3% allocation to your emerging markets, and then 32% to Canadian bonds and 8% to American bonds. So 40% of the portfolio is in bonds. So I'm just going to dig into XEQT. That's the 100-0 portfolio. So no bonds, all equity portfolio. And you can see that year to date, since January 1st, 2023, it's up 13.34%. The US markets have had a very good year so far, whereas Canada is generally a little bit flat, but because it's overweight in the US, you can see that it's having a good year as well. You can see the historical returns, and you can see how new this product is. They don't have any data going back 3 years, and you can see the dip there when the pandemic hit, so it was off to a good start. It lost a lot of its value during that pandemic, like all other portfolios as well. And then it grew quite good after that, quite quickly. You can see here that the number of holdings is 4. And again, it has only 4 ETFs in it. 1 for US, 1 for international, 1 for Canada, 1 for emerging markets. That's all it has. It has 4 different holdings. But you can see the number of underlying holdings. It actually owns 9,187 individual stocks by owning those 4 ETFs. You can see the fees for owning this portfolio. So 0.20% means for every $10,000 that you have invested in this ETF, they're going to take about $20 every year to do all the behind the scenes work. If you watched any of my index ETF investing videos, you saw that you could easily build a portfolio at 0.12%. So that difference of 0.08% means for every $10,000, you could save yourself $8 for every $10,000 you had invested in this per year. But again, there's a lot of advantages to holding just this. And here are the holdings at currently as of November 28th, 2023. So you can see that ITOT, that's the US ETF that they use, XEF, XIC, and XEC, and you can see their weightings. So ITOT right now, so their target allocation was 45%, and it's currently at 46.7%. XEF, their target allocation was 25%. It's at 24.47. XIC's target allocation was 25, and it's at 23.5. So it's all very close to their target allocation. What happens when it goes off of its allocation? These generally are rebalanced every quarter. So every 3 months, there's people that go into this and make sure that that one of the ETFs has not gone too far above or below their target allocation, and when it does, they will simply rebalance it all for you. So again, all you have to do is select your risk tolerance, and they will do everything for you behind the scenes. They're going to rebalance. They're going to select the geographical allocation. All of it is done for you for a 0.2% MER. So it's really, really convenient. If you want to look at the underlying holdings, what you have, again, ETFs are generally very transparent. You can see what you're holding. Just click on the download holdings. It takes you to this spreadsheet, and you can see there's the 4 different ETFs in your portfolio. And if you scroll down, what are the companies that you own mostly? And you can see that Microsoft and Apple, Amazon, Royal Bank, Nvidia, TD Bank, Shopify, Google, all the big companies are there. And you can see the weighting of each of those individual stocks. So you can see Microsoft would be 2.99% of your portfolio. So that means if you invested $10,000 into XEQT, $299 goes to Microsoft, $295 goes to Apple, $141 goes to Amazon, and so on. So you put in the $10,000, and behind the scenes, someone is distributing all of your money into all of these different companies for you. I've created a small list of asset allocation ETFs from some of the bigger providers here in Canada. Again, none of these are recommendations. These are all great. You can see that the MERs are extremely low for all of them. Basically, they're 0.2%. Don't be scared away by Vanguard 0.24%. That 0.04% over the long term doesn't make a huge difference. What I do have students and people that I'm helping out look at more than the MER or the yield or anything like that is the geographical allocation. So those are really the only slight differences. So if you wanted a higher portion in Canada, then maybe the VEQT is right for you. If you wanted a higher portion in the US, then looking at it, XEQT is right for you, and so on, right? I mean, you could throw a dart at one of these, and whatever it hits is the one you select, and you wouldn't be wrong. These are all great products. You can see how many stocks, how many companies you're actually holding, between 6,000 and 30,000 different holdings in these. These are fantastic products at a low price, and it makes things very simple for you. You buy one ETF, you don't have to figure out which ETFs you have to buy more of or less of. You don't have to use spreadsheets. You don't have to rebalance. You don't have to do anything. These are great. You can own a balanced and diversified portfolio with a few clicks of a button. These were not available when my boys started investing. Had they been, this would be something that I would absolutely have had them set up. But because they built their own portfolio and they enjoy doing that, we haven't changed it or anything like that. And we have a little competition going and stuff like that. So we've decided to keep it as it is. And I don't have one of these either. My portfolio's at the point where I'm looking for tax efficiency and I'm trying to lower fees, and I enjoy that stuff, right? It takes time. There's a lot of spreadsheets involved. Most people don't want to put in that extra work, and I don't blame them at all. These are great products. And you might be thinking, what if I wanted a 90-10 portfolio or a 70-30 portfolio rather than one of these offered? Building a 90-10 portfolio is as simple as putting 50% of your money into a 100-0 and 50% into an 80-20. So you could put $5,000 into VEQT and $5,000 into VGROW. And boom, there you have it. It's a 90-10 portfolio. So I hope this video has shown you how great these products are, how easy, how simple things are. Investing has never been this cheap, has never been this easy before. These are fantastic products. And I talk about them all the time with my class and people that I'm helping out. If you've enjoyed this video and you'd like to stay informed of others, please subscribe below. And as always, have a wonderful day.